When you were working, taxes felt straightforward. Your employer withheld money from each paycheck and forwarded it to the IRS for you. You rarely had to think about it. April arrived, you filed your return, and maybe you received a refund or owed a small amount. The process largely ran on its own. Once you retire, that entire structure disappears, and no one clearly explains what replaces it. There is no welcome to retirement letter from the IRS. No checklist shows up in your mailbox. No call from Social Security walks you through tax responsibilities. You move from an automated system to one where every choice is yours, and every error can cost you money. Many retirees lose thousands of dollars in their first couple of years after retiring, not because they made intentional mistakes, but because they were unaware of what the IRS expects once paychecks stop. Today, I will walk you through a complete list, 10 items. Each one matters. Many retirees overlook most of them. This video is for educational purposes only and does not provide tax or financial advice. Always consult a qualified professional before making decisions about your own situation. My name is Nancy. Each week, I explain tax rules, financial pitfalls, and strategies that help protect retirees from issues that are often overlooked. If that sounds helpful, subscribe now and turn on notifications so you never miss a video. Let's begin. Number 1, set up estimated tax payments, or you may face a penalty. While working, your employer withheld taxes from every paycheck. That withholding covered income tax, Social Security tax, and Medicare tax. The system worked automatically. In retirement, your income may come from several sources such as Social Security, pensions, IRA withdrawals, dividends, or rental income. The issue is that many of these sources do not withhold enough tax. Social Security only withholds a flat percentage if you request it, and even then it is often insufficient. IRA withdrawals may default to 10% withholding, while your actual tax rate could be higher. If you do not pay enough tax during the year, the IRS may apply an underpayment penalty. The rate can change each quarter based on federal short-term interest rates. The penalty is calculated daily on the underpaid amount for each quarter. The solution is to make quarterly estimated tax payments. These are typically due April 15th, June 15th, September 15th, and January 15th. You can set them up through IRS Gov. Under the Safe Harbor rule, if you pay 100% of your previous year's tax liability through withholding and estimated payments, you generally will not be penalized, or 110% if your income exceeded certain thresholds. Consider an example. You retire in 2025 at age 66. You receive Social Security, withdraw from an IRA, and earn dividend income. Your total tax liability for 2026 is $14,000. You had $8,000 withheld during the year, leaving $6,000 unpaid. If you did not make estimated payments, the IRS may calculate a penalty on that amount across multiple quarters. This could result in a few $100s in additional charges on top of the tax owed. There is also a potential waiver for certain individuals. If you are 62 or older, retired within the last 2 years, and had a reasonable cause for underpayment, you may request a penalty waiver by filing Form 2210 with your tax return. Number 2, file Form W-4V to withhold taxes from your Social Security. Many retirees do not realize that Social Security benefits can be taxable if your combined income exceeds certain thresholds. Up to 85% of benefits may be subject to tax. You can request federal income tax withholding directly from your Social Security payments by submitting Form W-4V or setting it up through your online Social Security account. This simple step can help prevent unexpected tax bills. Number 3, understand how provisional income affects taxation of Social Security. The IRS uses a calculation called provisional income to determine how much of your benefits are taxable. This includes adjusted gross income, tax-exempt interest, and half of your Social Security benefits. Depending on your total, a portion of your benefits may be taxed. Because thresholds have not been adjusted for inflation for many years, more retirees are affected today. Additional income can also increase the portion of benefits subject to tax, raising your effective tax rate. Understanding this calculation helps you manage your tax exposure in retirement. Number 4, check eligibility for additional deductions available to seniors. Some tax provisions may allow additional deductions for taxpayers age 65 and older, depending on income levels and current tax law. These deductions may be in addition to the standard deduction. Since tax rules can change, it is important to confirm eligibility each year and ensure they are properly applied when filing your return. If you believe a deduction was missed, you may be able to amend your return within the allowed time frame. Number 5, know when required minimum distributions begin and do not miss them. If you have a traditional IRA or similar retirement account, you are generally required to begin withdrawals at a certain age under IRS rules. These required minimum distributions are based on your account balance and life expectancy factors. Missing a required distribution may result in a penalty. Timing also matters, as delaying the first withdrawal could result in multiple distributions in the same year, potentially increasing taxable income. Planning ahead can help reduce this impact. Number 6, consider qualified charitable distributions if they apply to your situation. Individuals above a certain age may be able to transfer funds directly from an IRA to a qualified charity. This can count toward required distributions without being included as taxable income. If charitable giving is part of your plan, this approach may offer tax advantages compared to donating from other sources. Number 7, evaluate Roth conversion strategies carefully. The period after retirement and before certain required distributions begin may offer opportunities to convert funds from traditional retirement accounts into Roth accounts. While taxes are paid at the time of conversion, future growth and withdrawals from Roth accounts may be tax-free under current rules. Market conditions and income levels can influence the potential benefits, so it is important to evaluate this strategy with professional guidance. Number 8, be aware of how income levels can affect Medicare premiums. Higher income may lead to increased Medicare premiums based on income-related adjustments. These adjustments are typically based on prior year tax returns. Large one-time income events could temporarily increase premiums, so planning income carefully may help manage these costs. In some cases, individuals may request a review if income changes are due to specific life events. Number 9, keep your address updated with the IRS and review all correspondence promptly. If you move during retirement, make sure your address is updated so you receive all official notices. IRS letters often include deadlines, and responding on time is important to preserve your options. If you are unsure about a notice, consider seeking professional assistance rather than ignoring it. Number 10, compare standard deduction and itemized deductions each year. Taxpayers can choose between taking the standard deduction or itemizing deductions, such as state taxes, mortgage interest, and charitable contributions. The better option can vary depending on your situation and changes in tax law. Reviewing both options annually can help ensure you are not missing potential tax savings. Let's summarize. 1, set up estimated tax payments before the next deadline. 2, request withholding on Social Security if needed. 3, understand how provisional income affects taxation. 4, review eligibility for senior-related deductions. 5, track required minimum distributions carefully. 6, consider qualified charitable distributions where appropriate. 7, evaluate Roth conversions during lower income years. 8, monitor income to manage Medicare premium adjustments. 9, keep your address current and read all IRS correspondence. 10, compare deduction methods each year. These 10 points are important for managing taxes in retirement. Many retirees are unfamiliar with them when they first leave the workforce, and overlooking them can lead to unnecessary costs. This is Nancy. If you found this video helpful, click the like button so it can reach others who may benefit. If you have not subscribed yet, subscribe and enable notifications so you do not miss future updates. If you know someone who recently retired or is planning to retire, consider sharing this video with them. It can serve as a helpful checklist during this transition. Leave a comment and share which of these points was new to you. I read all comments, and common questions may be covered in future videos. I will see you in the next one, and please subscribe Senior Support USA for more updates and tips and